Your market news now. Global stocks rose, led by tech names as investor focus shifts to earnings from U.S. mega-cap bellwethers this week. Safe haven gold has fallen more than 4% since its Friday high, albeit still not far from record peaks set earlier in the month. Still to come in the earnings-packed week are results from tech giants such as Meta Platforms, Alphabet, as well as Microsoft. Meanwhile, U.S. GDP figures and the March personal consumption expenditure data, which is the Fed's preferred inflation gauge, are all due this week. This will be crucial for the dollar and investors' attempts to try and gauge the path for U.S. rates. To give us more perspective on the markets, we are joined by Chantal Marks from FNB Wealth and Investment. Chantal, thank you so much for your time. So let's talk about what is driving markets in detail. Is it just all about these tech names that we're looking out for?
Well, it does seem like that upon first glance, because we've definitely seen a resurgence in tech stocks following a pretty substantial havering last week. I think that earnings season so far has played out better than expected. We're also getting a lot of positive thrust, even from where companies are missing, based simply on their guidance, with Tesla being case in point overnight. I mean, that stock disappointed on the revenue and earnings line, but the fact that they are looking to pivot their strategy towards what the market wants has driven up that share price substantially in post-market trade. So I think that kind of narrative that's coming out of the US companies is really driving markets right now. To a lesser extent, I think there's a little bit more optimism around China at the moment. We have seen some support for commodity prices, although it has been volatile, as would be expected. So from a South African JSE perspective, we are seeing the miners quite nicely supported today as well.
With that said, then, what are the expectations for the Magnificent Seven versus the other companies that are set to release their numbers?
It's actually quite divergent. So when I delved into what those expectations are, it really is quite different for a name like Nvidia, for Meta and Amazon, where exceptionally high growth is expected, versus the likes of a Microsoft, where you're still expecting double-digit growth, but nothing near the 100% level that you are looking for in the case of Nvidia, for example. And then you have a couple of companies among the Magnificent Seven that are going to struggle this earnings season. We've already had Tesla reporting very weak results. I think earnings was down almost by half. And we also have Apple expected to release pretty soft numbers as iPhone sales in China come under pressure. So overall, it should outpace the rest of the market. But within that Magnificent Seven basket, it is quite divergent.
Let's talk about Capit Tech for a bit, because they released their numbers yesterday, and we're kind of seeing this idea of them developing into this diversified business. They've managed to fully rather kind of bank their clients. They've done really well in terms of winning their fully banked clients, that is. But what do you make of the valuation? Because analysts say it's still expensive.
Yes, it absolutely does look expensive relative to the rest of the banking sector. I mean, when you just look at something like price to book ratio, it is far ahead of the rest of the sector. That's now the measure that you use to very crudely value banks. The difference with Capit Tech is just that you do have this massive cross-sell opportunity, and it seems to be quite effective. So as they're increasing their value-added services, they are doing a very, very good job of rolling it out to a big proportion of their clients. I think one of the reasons they're winning there is a lot of their clients may be underinsured, for example, or are not that sticky when it comes to prepaid airtime, for example. They don't have contracts at big mobile providers. So you do have that opportunity to push that cross-sell a little bit harder than the other banks. And as a result, growth is expected to be higher. And I think that is what is reflected in the valuation currently. It's not to say I don't think it's expensive. I do think the stock is expensive, but I think it's expensive for a reason.
So on Friday, we're expecting the Fed's preferred inflation measure when it comes to the PCE data. What do you think is the big question here for markets when it comes to US inflation?
I think the biggest question is whether what we've been seeing in the headline inflation prints and the core CPI is actually filtering through to the consumer, because that's what this PCE inflation indicator is all about. It's about personal consumption expenditure. and by how much that has increased. I think a lot of consumers will be adjusting their spending patterns because of cost of living constraints in the US. So I think what the market wants to see is that PCE isn't climbing by as much as the traditional CPI measure, and perhaps that would give the Fed the opportunity to still cut rates this year. On the flip side, if personal consumption expenditure is even more than what CPI suggests, then we would be in for a Fed that keeps rates higher for longer. And increasingly, a few market commentators are actually suggesting that there could be hikes on the cards if inflation remains quite high.
Do you believe those market commentators? Are you expecting a hike if inflation does remain sticky or seem to be reaccelerating?
So at this point, I think it's going to be very difficult for the Fed to justify a hike, even though the underlying economy is still solid. I think the mood on the ground in the US is that there's a cost of living issue. I also think that they've guided so extensively for the next move being a cut, that what the Fed would rather do when inflation comes in higher than expected is to wait and keep rates higher for longer. I think that will still have a negative impact on markets. I think it will still be restrictive from an economic perspective, and that should, in theory, slow inflation down. Of course, there's always the risk of shock events that lead to a spike in inflation, and then I think the narrative can justifiably change.
Chantal, thank you so much for your time. That is Chantal Marks from FNB Wealth and Investment. And today we are waiting for results from Meta Platforms. Tomorrow it's all about Alphabet as well as Microsoft. And if those results do come in within expectations, that could trigger a rebound. But if those earnings come in fall short of market expectations, we could see another trigger to the Nasdaq, in which it will actually drift to the negative side. However, also we are looking out for US first quarter GDP figures, which are out tomorrow.